The next question was about stake lending, and we had this in our Facebook community, and I received a few other questions because Stake came out and said that we're going to start offering the ability for you to have your stocks lent out and potentially receive some extra passive income.
Yeah, so Stake is going to stake your investments, basically, just like they do in crypto land. Basically, that's what's going to happen behind the scenes.
We actually recorded...
We recorded this full episode.
Yes, we recorded this last week. And then a couple of hours later, Stake came out with another email saying, hold up, guys, we're putting a pause on this program until we iron out all the kinks and make sure it's ready to go. So we've slightly changed it because it would have been active by now.
Yeah.
But the thing that stood out to us the most about it was that it was going to be an opt-out system. So if you didn't opt out, you were automatically part of this stock lending program.
Yep.
And this is particularly for people who use Stake US to buy and sell US shares or ETFs and things like that.
Yeah. So basically, the way that it works is your investments can be lent to someone else. And that person or that institution that takes control of your shares for a little while, they pay a fee, and that fee is then shared back through Stake and back to you. And it was revealed that 20% of that income would be shared, that Stake receives, would be shared back with the end user. And they gave some examples, didn't they, Kate?
Yeah, of the
amount of money that you might be able to earn.
Yeah. So they were saying potentially, and you've got no guarantee that the stocks that you have in your portfolio would actually even be lent out. There might not be the demand for that. They might have enough people there. So it's all very much approximate, estimated numbers. But they were saying if you had, say, $5,000 or US worth of Tesla, and that was lent out for the entire year, you might earn $75 US that year for being part of the program.
So there are a few assumptions here. One is it's Tesla, so that's it depends. The rate that you receive depends on the security that you hold. They didn't even use a stock as an example. I was just inserting that in. So they didn't even say what company. So this would assume that it's just $5,000.
It just says hypothetical stock value on loan.
Okay. So then you've got to have it loaned out for the full year, which might not be the case. And you don't necessarily know, like this is still hypothetical. And you might never have any of your shares loaned out because the shares that you have might not be the ones that are valuable to other people. So Kate, can you explain just at the high level how securities lending works?
Yeah. So let's say you as a short seller want to borrow some shares to cover one of your positions.
Yep.
And I have the shares in my Stake or whatever brokerage account. And I'm in the opt-in. So I've got stock lending turned on. So my broker is free to lend my stocks out. So there's quite a few middlemen and people involved here. So we won't get into that because it got a bit complicated when we tried to explain it like that last week. But essentially the middle person will facilitate lending my stocks that I have in my portfolio to you for a certain period of time.
Yep.
And in return, you'll put up collateral. So you'll say, okay, I'm going to put this cash or these other stocks in a separate account. So there'll be a custodian on the side who will hold on to that collateral. So you're putting up 102% in this case of collateral. So even if
something goes wrong with my ability to repay you,
I can take the collateral.
Yeah.
And so there's probably a lot of stuffing around and paperwork and things involved there, but that's how it will work. And so you put the collateral up, and in return for you getting to borrow my shares, you also pay a fee. So that's what Stake's saying is this is the passive income you might get into your account, is you as the person, the end borrower, is paying a fee for the privilege.
Yep.
And so there's middle people involved that help facilitate this transaction. So I don't personally know who is borrowing on the other end. And they will help make that happen. And so there's collateral there as a security. There's a lot of intricacies to this as we got involved in. Things like voting. I can't vote while you have my stocks.
Yep.
And so if I'd want to vote, I'd have to opt out. These loans can be turned off same day. So if I wanted to vote tomorrow, I could turn out, opt out. I'd get my holdings back. Then I could vote opt back in and maybe have my stocks lent out again.
Yep. And Stake's pretty good with the voting too. They tell you if there's things coming up.
Yeah, I think they're right in my inbox. Your vote matters, vote on this. So that's good, because I think shareholders should be interested in what their company's doing and actually take an interest in voting on key issues, especially if this company's making up a portion of your portfolio.
But the big thing is that underneath the surface of Stake, there's a company called DriveWealth. And the company DriveWealth is the company that basically does all of this.
Yeah. So if you use Stake US right now, they're your broker partner in the US.
Yep.
So Stake doesn't have its own US operations. It's using a partner, DriveWealth, and other Australian brokerage platforms also use DriveWealth.
Sharesies use DriveWealth.
There might be some more. I haven't gone that far down the track, but DriveWealth are the ones that last year said that they now offer stock lending. So platforms such as Stake can now offer that to their users.
Because people are wondering, well, Stake's basically free if you've got money in your US account. It doesn't cost you to buy or sell. Well, here's one way that DriveWealth and Stake can make money from you.
Yeah, so at the moment, Stake makes money off the exchange rate, so they add a bit onto that.
Yep.
And they also make money off like their Stake premium levels and things like that. And they also have a self-managed super fund feature they've added. But this would be another revenue source for them because they're not paying you everything they get. So there's lots of middle people. So DriveWealth are getting a cut for facilitating this. The custodians getting a cut. There's probably auditors and all sorts of things involved getting a cut for facilitating this program. But you are getting a small portion of that, and Stake is also getting income from this program.
The big issue is that people don't necessarily understand the risks involved. But what Stake is there, it seems from an AFR article, what they're trying to suggest is that, well, this kind of should be a more normalized thing. Like this is what institutional investors do. We've got a white paper here from Vanguard, another one from BlackRock.
So this actually sent us down a rabbit hole because it's a $1 trillion program running globally. It's like securities lending is massive in the US. It's big in Australia too, but it's happening with your super funds and your large hedge funds. Like you're not hearing about it as an individual investor. Yep. So this is the first time that a broker is actually bringing our attention to this matter. But yeah, Vanguard also do this. So they've got their own securities lending program in Australia within their ETFs. So if you want to learn more about how this all works, like Vanguard have their own rules and procedures to make sure it's a really safe and secure program that they're running. But there's one paper called Australian Securities Lending Key Considerations by Vanguard Australia. So I'll put that in the show notes. So that really breaks down what is securities lending, how they do it, how that brings your fees down, because instead of having it as a revenue source, after their fees and costs for running the program, they put that money back into
lowering fees, which is why the fees on, say, Vanguard VAS are actually lower than they look. So the actual fees you pay will actually be lower than the 0.1% that you see there.
There's also another paper from the Reserve Bank, which is all about the equity securities lending market in Australia, which also has some charts and things. So that's quite good if you want to read about it from a different perspective, a bit more of an independent perspective. And then there was also another interesting paper I found from BlackRock, which was looking about securities lending through the sustainability lens, because as I mentioned, you can't vote in some of these things. And so for big ETF providers like BlackRock, voting, they have a lot of power when it comes to their vote. And so
if they're lending the stock out,
they can't vote on key issues. So this paper looks at how they view securities lending for a sustainability and an ESG lens, and how they weigh up the costs of not being able to vote on key issues versus having the securities lending program being able to keep costs down for investors. So I'll put all three of those in the show notes. So if this does interest you for when Stake do open their securities lending program, and if they do, I'm not sure what's happening right now, it's just on pause. I'd say these are three papers that do give you a really good overview of how it all works, and you can understand them. They're not completely ununderstandable like some papers I read.
Okay, so there are some things like, so first of all, you can opt out of this Stake thing. You can go into your settings. There's about like 5 or 6 different steps to, if you're not happy with it. Like if you just think, I don't really care about stock lending, I don't want the additional risk, and I don't care about the additional income, you can do that.
Or if voting's really important to you and just having a simple knowing, because you're going to have to pay tax on any income you get through this program. So if it's still there, it was there a few weeks ago when I opted out, but you go through Wall Street account settings, trade settings, and then stock lending settings, and you can opt out.
Okay.
But that was a few before I actually went on this deep dive. So I'm not quite sure what my decision would be now, but I'll have to think about it a little bit more. But it definitely opened my eyes to the whole thing.
Yeah, and at the end of the day, the risk is pretty low. Of like the risk is that DriveWealth, which is the company that facilitates all this, basically goes bust because they can't, get the money back from people, and all these things happen, and then you have to chase money down through like multiple layers of bureaucracy in an overseas location, which is unlikely.
Because you've got the collateral. It's something happens there with DriveWealth and the custodian, and things get a bit complicated.
But there'll still have to be people come in and...
But usually this is happening like automated on a daily basis. It was a very streamlined system generally from what I've read. But it'll be interesting.
Yeah. And the thing is, if you're concerned about this, you might also just be concerned about stake in general, right? Like if that's your concern, well, why would you have a stake account at all then if you're worried about, this going wrong? So, there's that. The other thing is, if you do, you can opt out on a case-by-case basis. So you can basically you can turn your thing off for a little while, turn it back on. But the problem is that DriveWealth, that's not good for them. The founder of Stake in the AFR suggested that they had to make it opt out and basically make everyone do it, because that would be the only way that they reach scale and actually make it viable for them to do. So it's interesting. If you do have a concern about this, write into us and let us know what you think. Jump in the Facebook group or
we did quite a lot of research into this, but we've pared it back because it's on pause. So it's something we might look at more once there's some more information available and it does go ahead.
This could be commonplace in the future though. It could be. And it's probably the only way to do it is to solve it through technology, which is what's happening. So
I think it just got everyone's attention because it's the first time this has really happened on a retail front, and so not many people knew about it, and I didn't know much about it either. I knew it existed in theory, but I didn't know the intricacies. So we'll unpack it more.
It's been happening with the fund managers for a very long time, as long as I've been investing.